So the impetus for this particular moment, this time that we would become more financially literate is kind of what we're trying to do and really work on understanding money, not from the perspective of how much can I give the church, which is a lot of what we talk about. How much can we give to God and give back to God's kingdom? But how can I make sure that my family and my life is taken care of in a way that I'm not a burden to society, to the church, to culture, to my family, to people around me. And out of this, the reason for this rather was we had about 52, or actually more than that, more than 52 deaths last year were family members of disciples or disciples themselves. We lost 3 members of our church family. We lost a whole host of very close, immediate family in the church. And what we found was that there were people that didn't have insurance. There were people that didn't have wills. There were people that weren't established and didn't have the floor in place so they could make sure that their needs were taken care of. And then I felt that we need to do a better job of educating the church. And so this is not a one-time thing. This needs to become a part of our culture. And I think one of the biggest issues is that young people don't understand that the time is now for you to learn about these things, invest, and make sure that you secure your future. And so here we are in our 40s and 50s, 60s. There are people passing away who, if they had thought about this differently in their 20s and 30s, they would have made sure that there was some security, some safety nets put in place. And so that's what this is about, amen? And so we don't want you to take this lightly and think, well, yeah, I got time. The time is now. And so Robert's going to come up, and Robert Jones is a good friend of mine, and lives in New Jersey. Was a young man that God put in our lives, and there's just a few men in that time frame. I think of Javier Manzon and Chris, and there were so many guys now that were teenagers that are now established. Javier being a doctor, Robert working on Wall Street. I mean, he just had a session, a time with Spike Lee and Russell Simmons and Carmelo Anthony, and talking about investments. This is what Robert does. It's not where he started. He's going to share his story with you. I mean, when I met him, he was just coming out of dealing drugs and a drug culture, but he wanted to change his life around, and he embedded himself as a disciple to changing his life without compromising God. And that's what I want you to hear. Robert changed his life without missing church, without making money God. But I can guarantee you he has made a remarkable change, not only in his life, but the lives of so many people he's touched because of his decision to make God first and make sure that he's adequate in this area of his life. So without any further ado, here is Robert Jones to speak to us today.
Thank you. I'm glad to be here, first of all. And thank you, Scott, for the introduction. So first of all, I don't manage all those guys' money. We were just in a meeting with some of the people. I'll give you some more of that information. But God has just been phenomenally gracious. And as Scott shared, when I first came to the church, just a little bit of background. I grew up in poverty. I'm from Queens, New York. I born in 1978, so I'm a little older than I look to a lot of people, but I'm almost 40, and I was born in 1978, and really the first real memories that I have as a kid was when people started to cook cocaine into what was called freebase, and my parents and just pretty much most of the influencers of my life were involved in that trade. Whether they were involved from a purchasing standpoint or from a selling standpoint, that was just how I learned finance. And so I remember my experiences growing up, I really understood the bank that we went to was a really great bank. I mean, it was pretty vibrant. A lot of people hung outside. When you go inside, you could buy things immediately as soon as you cash your check because it was a liquor store. And so that's how a lot of people in our neighborhood cashed their checks. I learned foreign exchange from the food stamp trade, right? Foreign exchange, 2 for 1, or sometimes 3 for 1, depending on the time of the month. And so I learned a lot of these things from the most, from life experiences. I didn't learn these things in school. Collateral. I learned about collateral and margin just based on the bail bond system. And so I would calculate collateral because I come home from school and it's like, oh, somebody got picked up. So we have to know, okay, they got picked up. We probably have to come up with X and X and make sure you have the collateral. So you'd have to know what the car value was when you drive to go pick up the person to bail them out. You have to know who owned their houses, and nobody owned houses. So then it's a scramble to figure out who owns a house and has a car to go pick people up. That's how I learned those were my financial transactions. And it's so funny that God turns these things on their head because through God and through His grace, I learned banking. I ended up in my career. I've been in Wall Street for a cumulative of 15 years. Last 12 at a hedge fund, and I ran a collateral department for one of the biggest hedge funds in New York. And I ran foreign exchange trades in the multi-billion dollars. And so these same things that I learned as a kid, I applied. But yet, I had to learn it a little differently. And the reason I'm here, and the reason I want to share this, the reason I even give that background, is because there was a stage, and for most of my life, especially being from where I come from, and having to play catch-up on literally everything. So I remember my first day at Morgan Stanley when they trained the class, and everyone has to sit down and go over their benefits. And all of the training classmates were just banging out 401k numbers and figuring out their percentages, and everyone's talking about it. And I'm looking around. I'm like, what are you guys doing? Like, what's this 401k? I didn't want to pay for my insurance. I didn't want to pay for 401k. I wanted to keep as much of that check as I could get because I wanted to have a nice apartment. I wanted to dress nice. At that point, I had an Acura. So I was thinking spending, and I was excited to have my income, but I was definitely not thinking wealth building. And so I looked around, and these guys are 401k and maximize and this and that. We're only making, these are entry-level jobs. It's pretty much on the higher end because it's finance, so you can afford to. But it was just a mentality that didn't make sense to me. And so over the years, I had to learn and relearn because no matter how educated we are, and I think, thank you for sharing that quote about the PhDs, no matter how educated we are, there's no inherent correlation in education in our current school system and financial literacy. And so you can know calculus, you can know 3 levels of calculus, but then just not really know basics of investing in the stock market. Or you can know all these about biology, you can be a doctor, you can be a lawyer, you can be a great musician, you can be, there's some of these things are complex, and the things that we learn are sometimes way more complex than finance. But because we think we're smart, then we're kind of a little bit embarrassed to say, I don't want to dumb myself down because I know calculus, I know rocket science, but yet I just don't know the real basics. So financial literacy is not inherently taught. And so as I went through my career, 15 years in, so I'd say probably about year 12, I really, to deal with the lack of understanding and the insecurities, I got some advice in the beginning of my career to say, if you're going to get to a stage in career where you should have some letters behind your name, because if not, you're going to start getting passed up. And so that advice, just like brother shared, that was the advice I got when I first started my 12-year career at this hedge fund. And I remember the brother Craig Holmes. You guys remember Craig? He sat me down for lunch, and I was like, what should I know about finance? He said, you got to get some letters behind your name before a certain age. And so I was like, all right, I'll do that. And I went and studied the hardest financial exam to try to somewhat catch up to what people knew and handled so well, but I had to handle. So it's almost like it's almost like I speak a different language. It's almost like someone that comes from another country and you're in a meeting with everyone that knows the language and they say a couple of things that are idiosyncratic or things that may not be clearly, it's just not real clear to you, or certain phrases or certain letters. And I felt like I was almost from a different language. I knew I was smart. I knew I could handle the information. I just knew I didn't have it. And so for really almost the first half of my career, when I'm in meetings, I'm trying to play catch up. I'm like, what does that mean? What does that mean? Kind of jotting it down. And it got to a point that I realized, and I took a fundamental shift. And I realized that, you know what? If I don't understand something, it's not my fault. If I don't understand something, it's because they're not explaining it well. And that fundamental shift helped me, and that's, the reason I say it is because that's why I am where I am today. Once I realized that it's not that complicated, once I realized that it's the language, it's the insecurities that really are hindering us from being financially literate, then I went on a lifelong quest of demystifying finance.
Come on, bro.
And I realized that we just have to demystify this stuff because we can't assume that it's learned, because it's clearly not. And you look at statistically speaking, only the state of Utah has a real strong financial literacy requirement. But then if you think inherently, whose job is it to teach financial literacy? Right? It's the kids that came out of college and that got a degree in education, and they went to that career trajectory, and if they're able to afford great savings or stock, to invest in single stocks, or if they have a great portfolio, that's a very rare feat for most teachers and most teachers' salaries. But they're the ones expected to teach our kids how to save when they become PhDs, like this brother shared. And so we're not set up currently for us to thrive financially unless you start out with a certain amount of money. Let me explain that. It does not make sense for a financial advisor to sit down with someone who's investing less than, in some cases, $100,000. It doesn't make sense. It's a waste of their time, because they can only earn a certain percentage of what you're investing in. So if their job is to make a living, which generally that's why they're not there for, it's not church, right? So they're there to make a living, and they have to think, okay, with this time that I have to, one, sit down with you to convince you to invest. Now you only have a couple $1,000, say it's 5, 10, 15. Now I have to convince you to part with your only $15,000 and then teach you all this stuff from scratch. Or I can get with somebody else who has $500,000. And at least I know I can get a couple, even that, you're only getting a couple $1,000 a year from that relationship. And so you need to get with a bunch of people with $500,000 to even make ends meet. Or, like the brother said, you can just sell them insurance, because you get the money right there. So no matter what they invest, no matter what they do, it's like, okay, you don't have enough to really create a brokerage account with me, and we really can't have a strong relationship. But I can sell you insurance right now, because that's an easy check. No matter how much you have, it's your life, your age. We come up with a number, and then I can get a check. So unfortunately, that's just where things are skewed. And so people, unfortunately, only interact with just that real basic insurance transaction, but don't really get an understanding of how to build wealth. And so I'll touch a little bit upon the formation of this company, and then we'll go into just to touch on what Scott shared. So I knew that was an issue that we needed to demystify finance. I knew finance wasn't taught, and I knew that many people grew up just like me. Many people grew up that your financial transactions were not sufficient to help you build wealth for the next generation.
Come on.
And even some people are saying to the 7th generation. And that's that there's a whole program out there that people are literally teaching to build wealth to the 7th generation. And a lot of that has to do with spiritual implications as well. We'll touch on that. So I realized that there wasn't enough, and I'm in church one day, and this brother's talking to me. He's like, Rob, you need to come and meet my students. It'll be great. They just want to hear, we're doing a part on finance and entrepreneurship, and I think you'd be great to come. And I was like, I'm not really an entrepreneur, but I can teach it, I guess. So I went in and had a great time. And so this is an inner city, 10th grade, inner city charter school. So it's 10th and 12th graders. And I went down to teach, and literally was absolutely floored by the amount of curiosity that these kids had about the stock market. And they just wanted to ask questions. They just really wanted to know so much information. And I felt bad. I was like, man, I want to do this a lot more, because one, I have 2 kids. That's Joshua and David right there, and wife right here. And they have sports. We go to church. I serve on the church board and do some teaching at church. So I have such a packed schedule, and I'm working in Wall Street, and I'm taking the train in and out of the city every day. I don't have time to come back to this school. I love these kids. I would love to talk to them. I don't have time. I probably can't come back. I don't have the vacation days to do it. I can't take the time away from my family. How can I do anything like this, and how does this work? And so it really bothered me, knowing, again, what I said about the financial advisors, they can't teach. And then after that, realize they don't have the capacity, I'll say it that way. There's nothing wrong with financial advisors. My wife's a financial advisor. And it would be great if there was a mathematical, sustainable way that we can teach and things of that nature, but that's not the answer. So I prayed about it after that meeting, and then here's how God works to make things clear. And sometimes, and this is something Scott taught me years ago, pray for God to open doors that no one else can open and close doors that no one else can close. And so here's one of these doors that God decided to open. After that class, I felt really horrible, and I felt almost guilty going to work. I got in my train, and the way it works in New Jersey, where we're situated, I live in an upper middle class neighborhood, and going into the city, we pass through some lower class neighborhoods, lower middle class, and I'm sitting down, lower class and then poor, and it just kind of goes down the spectrum. And I'm sitting in my chair, and I'm watching, the train's full, and I notice that all the African Americans get on in the lower income neighborhood stops, mainly women, because a lot of men don't come into the city, and a lot of men don't have jobs in these neighborhoods, and they're all standing because there's no more seats. And I said, I cannot live my life this way anymore. I cannot just be part of this. There's something not right about this, and I just didn't feel right, and I didn't have an answer. I didn't know what to do about it. And so, fast forward 3 weeks later, a couple of friends and I decided to have a meeting to discuss this, and let's just talk about it. What are some things that specifically more acutely in some inner city neighborhoods and specifically minority neighborhoods, there's just a lack of financial literacy, but yet a desire to know it, but there's really no real answers. There's no one out there. There's no NAACP like what they did for legal. There's nothing like that for finance. And there are some programs out there. There's a lot of money being spent on it, but it's not connected, and the kids don't know about it, and the kids aren't excited about it. And so fast forward, we had this meeting, and I had my laptop in my bag, and I planned just kind of like plan for here, just have a couple slides prepared, ready to say a couple things and say, this is the way I feel, get my story. And we planned this meeting. I knew some of these folks had great relationships in music, but as I'm walking to this meeting, the person walking in right in front of me was Russell Simmons. And I was like, okay, there's some people here. And so then I walked in, and then Eric Garner's kids heard about it and showed up. Eric Garner from Staten Island. And then I just started and I walked in and around, and then Tiffany was with me. We just started seeing people all over that we knew from TV. And I'm leading the meeting. And I'm like, oh, okay, I'm only 3 weeks into this thing. I better figure something out here. Okay. And so I just prayed, and it was like, God, and I talked to Scott about it. I was like, hey, Scott, there's going to be some heavy hitters here, and I'm planning, and I'm running it, and I've not done anything. So one of the things we talked about was just kind of doing a similar what we do with weights, where you kind of form a line and let people stand up and come and share a couple minutes and just make sure they don't share too long. So that's the format we said, because I can't come up there and talk to these people for an hour, because they're foundations, and they're running this and doing that, and I'm 3 weeks in with a dream. And so, so God blessed it, and I left that meeting with effectively a role, and they're looking to me for leadership. And I was stunned by it, humbled by it, but yet it called me to work incredibly hard to figure out this. If God, you did this for a reason, let me not bury this. Going back to Matthew 25, let me not bury this. There's something here that you want me to do, and a little bit more intent to be more intentional about. And so this is a year and a half ago now, and time goes really fast. And so over the time, I'm traveling around the country, and this person met that person from that meeting, and this person put me in contact with that person, and then this network just exploded, and now I'm talking to people all throughout the country about financial literacy. And at one point, I go to the south side of Chicago and go into one of the worst neighborhoods and just go into a class, one of the disciples that teaches there, set it up, and he's like, Rob, just whatever you want to say. They love to hear about this stuff. They don't get a lot of people from Wall Street teaching them, and they don't get anyone. It's never happened. And so we did the class, and it was about 45 minutes. Kids asked questions, and then some of these are older people as well. The class was over, and I'm leaving to go to make a phone call, waiting for the disciple who's a teacher to kind of catch up afterwards. The kids that were in the classroom left, got their friends, and then came with me into the teacher's office because they wanted to learn more. and I was humbled. Man, and they're asking questions about everything from Bitcoin to Amazon to Apple, and if this stock is $100, this stock is $1,000, that means it's 10 times better. All these questions that they had, and they really wanted to know, they're taking notes. And this is in the south side of Chicago, where there's 92% unemployment in certain neighborhoods. 92% unemployment for African American youth. These places are, and the murder rate, 100 shootings last July 4th weekend? And they're just asking questions. They want to know. They want to know this stuff in a deeper way. And I'm humbled by it. And so what I went upon, where that led me, was eventually to start a company called Economic Social Empowerment Strategies. And as of February 1, this is what I do for a living. And so it's just a blessing to see how many amazing-hearted Americans are out there. And I'm saying Americans, not Black Americans, Latino Americans, Caucasian Americans, Asian Americans. I'm talking about Americans. Everyone wants to fix this problem.
Come on.
I've been able to talk, I'm telling you, the bluest of blue blood, people that I spoke with that literally have belonged to country clubs where one membership is $500,000 and it closed to new membership in 1921. It closed to new membership in 1921. He shook my hand and said, Rob, how can I help? All the way down to just people that are trying to start their businesses. Hey, I'm here, I want to help. I'm talking about a kid, Javante down in South Side of Chicago. He's like, I want to help as many people as possible. My girlfriend wants to do clothing, and she's trying to, she has these great designs that she puts on these shirts and these jackets, and I want to figure out how to help her, so can you teach me so I can help her? And I'm looking at this kid, I'm like, this kid is in abject poverty trying to help somebody else, and trying to get help to help someone else. And that just made me go on this path of trying to figure things out. So why are we here, and what can we do with this time that we have together? What I would suggest, I have 6 easy steps to help teach financial literacy. Come on. These are steps that you can write down. These are steps that we will go over in a relatively decent speed, with the understanding that afterwards we'll have a couple of minutes to dive into any of these steps, but these are very digestible. And again, I'm not here to sound smart. I'm really trying to make it sound as simple as possible. So if you think that we need to go a little bit deeper, please feel free to raise your hand, ask a question, because I want to connect, discuss, and talk. There's nothing about financial literacy or anything that I'm going to talk about that is too complex. The hardest math you're going to need to know is how to divide. Does anyone here need a refresher on division? Okay. So if you understand how to divide, the math does not get any harder than that. Okay? And if it does get harder than that, it's cool because it's fun and you can have fun doing other things if you're more mathematically oriented or scientifically oriented. We can go into those things at another point, but for here, we're going to really go through 6 easy steps. And so the company that I started is called Economic Social Empowerment Strategies. And it starts with this concept of having a strategy. What is your strategy? Do you have a strategy? Malcolm Gladwell wrote a book a couple years ago called Outliers, which this brother, I think, attested to it, that talked about the Jewish immigrants who were all working in the garment district, and how that next generation, not a couple, that next generation, what their educational achievements were. And we're talking about the poorest textile workers that fled death in Europe, came over here, went to mainly in New York City and some of these bigger cities, went to work in textiles, and their kids were doctor, lawyer, dentist, doctor, lawyer, dentist. You look at the statistics, it's ridiculous, that it was a strategy. Okay, there was a strategy, there was a plan. That we are textile workers, but our kids need to get an education in specific fields in order for us to be successful to future generations. And so he already touched on that. I think you understand that. But that's my question. What is your strategy? Do you have a strategy? Do you look at your kids in the face and you say, that kid's going to be, whatever they do, they're going to be rich. That kid, I don't know, that kid. What is the strategy for your kids? Right? If your kid wants to be a musician, or if your kid wants to figure themselves out, be something more artsy, they may need a little bit of extra help. That should be part of your financial strategy. If your kid wants to go right into accounting, you may not need to do much other than pay for their education. But these types of things need to be part of your strategy. a wealth building strategy for not just you, but your family. How can I help them to build wealth? How can I set them up for a future? We are now facing negative, specifically I say we, African Americans in the United States are for the first time facing negative intergenerational wealth, meaning that this is the first time where the expectation is for our kids to be poorer than we are. The first time. Okay? It's also what's happening is the obesity epidemic. We're starting to see a curve there that they're expected to live shorter as the generations go because of childhood obesity. So there's a couple of things going on here that we need to be very mindful of. 50% of African Americans cannot come up with $2,000 in 6 months. Let me say that again. $2,000 in 2 months. Over 50%. And I don't want to go through all the statistics, but they're horrible. But let's just talk about this. What's the first step? So it's here. We're talking about the easy way to financial literacy. And so the first one, eat away bad debt. Eat away bad debt. Very simple. For every $5,000 you spend on credit cards, $1,000 of that is going into finance costs. For every $5,000 you spend, tack on another $1,000 for finance costs. All right? If you continue to do that, and remember, the two things that they say that the eighth wonder of the world is compound interest, right? If you either you're benefiting from it or it's destroying you. So your relationship with compound interest right now, and interest rates are going to go up, and we'll talk about that in a minute. But your relationship with compound interest, either it's a good relationship, you're benefiting from it, or it's destroying you if you have any form of bad debt. What do I mean by bad debt? Credit card debt. Living beyond your means. Constantly buying something new. I need this, I need this, I need that. You think of the fact that in the last century, this whole concept of durables just went right out of the window. We don't see anything as durables. What they realized was, back in the day, there used to be this thing called durables where I buy this and I keep it until what? It breaks, right? There was a concept that you kept things until they broke. But then that's not profitable, right? If I'm Panasonic, if I'm Sharp, and I make this amazing television, and everyone has it and it completely works, and everyone's able to do everything they need to on it, then, okay, we sold the television. What's next? We got to tell them to buy a new one. So that television's not going to break. We have to figure out a way to tell them to buy a new television. So we have to come up with, what's that, 3D TVs? Did anyone go out and buy? Oh, no, don't even mention it. Don't. Please. Why did they come out with these 3D TV? What's up with that? Like, they were like, okay, got the flat screens now. We have to get them to go buy 3D. Before 4K came out, it was before the Ultra HD. They had us buying 3D TVs, and no one had the glasses, and they come over to watch the game. So why are you even buying that? But they need to continuously sell. So there's a full-fledged assault on you needing to buy more. And you have to stop that. You have to have a strategy that says, yes, that is amazing, but not now. I would love that car, but not for us. I would absolutely love that new television, but not now. We absolutely have to have a strategy, because if not, you'll be picked apart by compound interest and this concept of instant gratification. Because you see something and go, I remember, and this is recorded, and he doesn't watch this, so even if it is recorded, there's a friend of mine, this is hot off the press too. He sent this text with, he said, son's balling for Christmas. And I'm looking at these things, he had a picture of 5 pair of sneakers, all these jerseys, video games. I mean, it looked like going to a store and looking at it like like you have a raffle, and you put a bunch of high-end items. That was on this kid's bed. He said, yeah, my son's balling for Christmas. And literally, the next text, you look at the text chain, next text is a group text. He said, hey guys, I'm short for rent. Please, I'm going to be out in the street. Guys, can someone help? Blah, blah, blah. It's right here on this text chain. I looked at it, it's like, and when I saw those Christmas gifts, I was like, I don't feel comfortable that he's buying all this for his son. I just don't feel comfortable. But, and so this instant gratification, this desire to buy things, the desire for kids to have the new this and the new that. The kids have the why do our kids need the iPhone 8 Plus, this and that? But they feel like they need, that's $1,000 computer. That's $1,000 computer. It sounds like a phone, sounds like this. That's $1,000 computer you're buying for your kid that you just bought a $700 computer for 2 years ago. Think about that. But you have to get it. You don't have to get it. And so that delayed gratification is something that we absolutely need to learn. So the only way to do that is to eat away bad debt. Next thing, and connected, save 10 to 15% of your income. Please, save 10 to 15% of your income. Now, some of you are like, Rob, there is absolutely no way with this rising rent costs and rising education costs and all these things, rising food costs, I don't know food, but these other things are rising pretty quickly. But with all of it, how am I going to save 10 to 15% of my income? That is completely unrealistic. Here's the thing. You have to try to figure out a strategy. Your strategy, to be honest with you, may need to be, instead of you binge watching Netflix at night, you may need to find something that you can learn that will make you more marketable.
Come on, bro. Wow.
That may need to be your strategy. I'm not saying this preaching down. I'm saying because that's what I did. Okay? I was in finance. I realized that people were making a lot more money than me. I realized that there's a whole new level. And I said, for me to do that, that means I need to stop playing Madden. This is Madden. Let me see if I can remember. Eddie George on the cover? No. I'm talking about, hold up, Ray Lewis on the cover. Right? Now think about that. Let's just say I was the best Madden player in Madden 26, 2006 or 2007, whatever it was. Let's just say, what does that benefit me right now? Right? If I played 2 hours a day, 4 days a week, exactly. I may have stronger fingers, maybe, but how does that benefit me long term? And what are stronger fingers going to do, right? Strong fingers to pay more debts, right? So I realized, like, what would benefit me from playing Madden? And I don't remember that. I was like, I'm not playing Madden. I'm not going to play. I'm just going to learn this thing. I'm going to learn finance. And let me tell you something. The math was hard. And I would I literally started, my thing was to put the kids down at 7, 8, and then go to Starbucks until they closed every night, approximately it ended up being a cumulative for 4 years. All right, there was 350 hours per test, and the test is made for you to fail at least one. They don't give you a grade, they don't give you a score. All they do is tell you pass or fail a couple of months after you take it. If you fail, you have to take it again the following year. And it's once a year offered. So for me, I went, and that's the CFA program, and that's the highest financial designation. And I said, I'm not going to play Madden. I'm going to do that because it's cheap. I don't have to go to business school, pay $175,000, whatever that number was. And that's what I did at nights and lunches. And I worked full time. I would do it on the train. I would take the Q25 bus to Queens College. I had to finish an econ degree. Scott remembers those days. And I just have a stack of books, and that was it. Now, I remember there's this passage in the Bible that I was studying the Bible with one guy, and he said, why is that in the Bible? There's a passage, what is it, at the end of, where Paul says, I think the end of 1st and 2nd Timothy, where he says, bring my books and my scrolls, or my cloak, something like that. I was like, how is that a scripture? Bring my cloak and my books? But think about it. I realized that is a very powerful passage. That meant that Paul really was focused on constant training, education, and learning. And this is a guy that says, I was educated by the best, but he still needed his books and his scrolls. And that lifestyle of constantly investing in yourself, investing in human capital, investing in making yourself, learning something new, learning something to bring yourself to a higher level of marketability is something that is inherently embedded in saving 10 to 15% of your income. It all comes down to the same root thing, delayed gratification. It is amazing to watch 24, which was the show that day, or back then, right? I could watch it, binge watch it, whatever the case may be. That's when binge watching first started coming out. But if I delay that, get this designation first, I can watch all the 24 I want.
That's right.
And be making a ton more money. And that's delayed gratification. So when I say save 10 to 15% of your income, that may require you to increase your income. How do you increase your income? You increase your human capital. What is your human capital? Your ability to be productive. Okay? How can I become more productive in this society? Maybe, and let me tell you guys something, the technology and everything has democratized information. You can, between iTunes, between Coursera, C-O-U-R-S-E, Course, E-R-A, Coursera, there are so many free classes offered by the top universities and institutions in the world that you can take right now. Right now, you can learn Python, which, raise your hand if you know what Python is. You can learn Python right now from UPenn, MIT, just start, go ahead. Sign up, it's absolutely free. The way Coursera works is you can pay for it if you want a certificate, but if you don't want a certificate, you just want to know it, you go on, you log in, tell it the course starts, you get all the information, the homeworks and everything, absolutely free. Absolutely free. And there are so many of these options. And then YouTube is the best. They teach you everything. I mean, everything on YouTube. And trust me, sometimes people are a little suspect. They're not the best teachers. So it's hard to figure out who's good and who's not. But at the end of the day, the information is available. So saving 10 to 50% of your income may mean either just save, if you're making enough and you're in a career that is advancing and you've done what you could to really make sure you're on the right trajectory. But then the other thing could be you just need to figure out a way to make yourself more productive. And that helps everyone. Just think about what your kids see. Think about what your family members see. And think about that, I was really encouraged when one of our aunts, she was a longtime nurse, and she became a medical doctor in her 50s. I think almost mid-50s. And that was just such a celebration for the family. It's like, man, she just became a doctor after being a nurse all this time. But she fought hard for it, and she really wanted to see what that next level was for her. What is that next level for you? What is your strategy? There's a book, and I won't quote it. I kind of question how many non-scriptural quotes I want to make, but I'm going to do this one. The Book of Five Rings. It's a Japanese version of Art of War, and it's written by a samurai warrior. He starts the book by saying, I've had 60 battles through from 13 to 28. I've never lost one sword fight. They call it sword fencing. Never lost one sword fight, and I thought it's either talent or divine intervention or something else. And then when I was 50 years old, I reflected and realized it was all strategy. Wow. And that's the Book of Five Rings. It's all strategy. What is your strategy? What is your plan? Financial literacy is defined as the ability to understand and manage, and the confidence to execute your short-term and long-term objectives. All right? So it's the ability to understand. One, you have to kind of know what's going on. And the confidence to manage. Confidence to manage. I believe the understanding we can get very easily. It's the confidence to manage that goes back to what this brother was sharing earlier. You have to be able to talk and sit down with someone and say, I think I know what I want to do. I want to do my first trade. I want to buy my first stock. I want to go to my first, but it's that confidence that you need. Part of your strategy needs to be, okay, how can I get confidence to actually execute this plan? So again, it's the ability to understand and the confidence to manage your short-term and long-term objectives. Knowing that your life events are going to change and the market conditions are going to change. And so this is an ongoing conversation. And it could be through, and one of the things that I'll talk about a little bit later that I'm developing is to solve that financial advisor issue. We have a website and we have a learning management system, so there will be access to this information for free. And that could be part of it, just joining an online community to discuss these things. So joining an online community, hey, this is what I'm thinking. You can put an anonymous, whatever the case may be, and say, hey, what would you do in this situation? You can write down all your things. And so those things are going to be available, and we can talk more about it at the end. But save 10 to 15% of your income. Now, here's this big one, and I could park here all day, and I'm going to come back to this because this is the fun one. Equity, equity, equity. You have to have equity somewhere. You absolutely have to have equity. All right? Does anybody know the difference between fixed income and equity? Does anybody, by show of hands, if I say there are two types of investments, either fixed income or equity, does anybody know the difference? I see a half a hand going up. You want to do it? Want to try it? Okay.
So fixed is like, it has an interest rate,
That's exactly it. Fixing. So when you are looking to investing, there are two types of ways to invest. Two main headings of what the financial vehicles you invest in. Fixed income, which you've probably heard that term, and that's the first term you can hear when you get with your financial advisor, or the first term you hear when you talk about long-term planning or asset allocation or portfolio construction. They'll talk about fixed income. What does that mean? It's just you get a fixed amount of interest when you engage in that financial vehicle. So a bond is just, give me $100,000, I will give you 6% on it, then I will return your $100,000 in a predetermined term. It could be 5 years, it could be 10 years. The U.S. government offers bonds. That's the basic borrower that sets pretty much the entire world's financial systems up. And they set the rates to say, right now, if you're going to put your money away for 2 years, this is about the rate you should expect. If you're going to put it away for 5 years, this is about the rate you should expect. And put it away in 10 years. And so this concept of fixed income just means that there's really relatively low risk, and you get a percentage back. As brother shared a little bit earlier, now where are the rates right now for fixed income? Does anybody know? Would you say they're good, bad, mediocre? Bad. Bad, right? So to stimulate the economy, the government needs to lower rates because once the government decides where the rates go, then every other company, every other corporation, every other lender now adjust their rates downward as well. So fixed income has not been the way to build wealth in the last couple of years, and it's really since the Great Recession. Why? Because with fixed income, the rates are so low that a lot of I don't want to misspeak because there's so many different needs in the room. So I'll say this: if you are closer to retirement, you should have fixed income because you need that fixed amount because you can't afford to deal with fluctuations. You need something to be fixed and solid, okay? If you're not nearing retirement or with a portion that you don't need over the next several years, you should be in equities. And I really want to park there, equities. This brother shared. Equities, instead of fixed income, the difference with equities is that the amount that you're going to get is not fixed. It's not fixed. You get an upside potential or a downside potential. And so it's a lot riskier. But that's the way wealth is made. If you understand the value of equity, I tell you, it'll be one of those things that can become an addiction. Let me explain. Warren Buffett, and I want to coin this term, and I want you to keep it and just think about it in the back of your mind and say, I want one of those. Warren Buffett started with a 5-bagger. 5-bagger. All right? I want this term to be all over. B-A-G-G-E-R. All right? This is rich talk for when you multiply your wealth by 5 with one investment. Multiply your wealth by 5 with one investment. So think about this. Warren Buffett in the 1960s invested in this credit card company that was trying to diversify. They were like an inventory warehouse credit card company that was trying to diversify their business, and they bought this oil company, and this oil company basically had this inventory, major inventory issues, and this company called American Express kind of ventured into an area that they shouldn't have been in, and their stock got crushed when they found out there were some inventory issues for the oil company they bought. Warren Buffett says, American Express, they're not going nowhere. Why? He's like, they're trading below their actual book value. So he put all of his money into American Express because he knew it was a solid company, and that was just one little blip in the radar that people were overreacting to. And so his thesis is buy from the pessimists and sell to the optimists, right? And people were real pessimistic on American Express. And he's like, no, their business model is solid. Just because of this one little blip, they're going to recover, they're going to figure it out. He made 5 times his return on that investment. Then, many of you who are kind of born in your mid-30s and above kind of remember Coca-Cola in the 80s. Remember when they came out with the new Coke? Yeah. How did that do? It was horrific. New Coke, absolutely horrific. They tried to rebrand themselves, made a big mistake, sales went down, stock tumbled. You know what Warren Buffett did? He said, all right, Coke's going to figure it out. I drink it every day still. They're going to figure it out. 7 times return. Heinz, 4 times return. These are basic household things that you know good and well you're going to go buy again. You know you're going to use your Amex. You know people are going to drink Coca-Cola or whatever derivative of, because they make healthy stuff as well, as you know, right? And you know people are going to use Heinz ketchup. That's the best. If you go to a restaurant and they give you Hunt's, I get offended. I'm like, are you seriously that cheap? Why do I have Hunt's on my table? And this is like, I hate Hunt's and like the cheap plastic forks. Those just give me a solid plastic fork that's not hollowed out in the back. I don't understand why people do that. Show me some quality, at least try. But anyhow, Heinz is always going to be the best ketchup. No way around it. No way around it, right? So Warren Buffett. So think in these 3 investments, normal household investments. If you understood the value of equity and this concept of a 5-bagger followed by a 7-bagger followed by a 4-bagger, if you invested $100,000 in Amex and just follow these same 3 investments, and Warren Buffett made a ton of these. If you were to follow these same 3 investments, your $100,000 would be worth $14 million. Your $100,000 would be worth $14 million. Now, granted, he's the best investor in the world. It's very hard. But that's why I didn't come up with these insanely crazy complex models or these complex, he found the derivative of this and the option price and the volatility was a little bit low. So he then did a multivariate analysis and he found out that this is regression is chasing that. Yeah, I'm not doing all of that. That's fun stuff. I love that stuff. But that's not what he did. He said, Amex is not that bad. Let me go buy it. People are due down on them. Amex is still a good company. And he bought it. And so the principle of equity is being able to participate in upside potential. Well, Rob, what are you talking about? Heinz, the ship has sailed. Amex, the stock market's all-time highs, all these things. All right, let's think of this. In 2012, there's an e-commerce company that was starting to cause some ripples. And that company is called Amazon. Okay? And that's before Amazon Prime. That's before any of these other things. It seemed like a pretty cool company. And a lot of us, show of hands, have heard of that company, right? Okay. Who knew it was a good company? Scott? A couple people knew it was a good company, right? And just so conceptually, so you understand how equity works. All right? Let's look at this chart. If the company, Amazon, the market cap, meaning the value of the entire company, in 2012 was worth $88 million, okay? And you buy 1 share of that company, then the entire company, in and of itself, the next year is worth, or in 2014 is worth $165 billion. Your investment has doubled. Does that make sense? So as the company doubles, this isn't fixed income. It's not a fixed amount. Amazon's not saying, hey, we want to keep growing. We want to be in everyone's neighborhood. We want to be to your door in a matter of seconds, which is where they're getting, right? They didn't say, hey, can you take a loan? They're saying, no, give us your money, and then as we grow, you grow with us. It is a publicly traded company owned by the public. And so the people who invested when the company was worth $88 billion, bought a share in 2017, have seen more than 5 times growth. So if you invested $10,000, what is it worth now? 50. 5 times. If you invested $100,000, it's $500,000. And then what are you doing? I'm going to shave off these profits and on to the next one. That's a 5-bagger. I want you to, and the reason I'm using that term is because that's how the wealthiest of the wealthy investors think. How can I get a multiple on this investment? Now, with that said, and we can go back to that, but with that said, you absolutely have to weigh your risks.
Yeah.
All right? I want to give you the upside. I'm not trying to sell a pie in the sky and say there's these hot stocks and these things are all great. So the next step on the easy way to financial literacy is just weigh your risks. All right? It's beginning of summer, and the best way to describe diversification is this. Beginning of summer, and you don't know if it's going to be a rainy summer or it's going to be a sunny summer. And you have an option to invest in ice pops or umbrellas? Okay? Beginning of the summer, it's June. Someone gave you $100,000 and said, invest in either ice pops or umbrellas. Which one would you choose?
Ice pops. Yes.
Raise your hand for ice pops.
Can I do that?
Raise your hand for umbrellas. Raise your hand for both. Right? If you invest in both, you make money what? Rain or shine, right? That's what it boils down to. That's diversification. If you think, and this is all Wall Street does, pretty much, is figure out how can we predict the sales for this upcoming quarter. That's all Wall Street does. That's everyone, all these billions and trillions of dollars flowing throughout the system, these big asset managers, and what are they doing in those offices all day, and what's on their computer screens, and what's on the walls, and what are they meeting about? What's all that for, and these big, big checks, is to predict revenues and predict earnings for the next quarter for publicly traded companies. That's all we do all day. And when you go to predict the revenues, you look at different factors. But who has a crystal ball? Who knows? And so there's a level of execution you can have. We shared the Warren Buffett Amazon idea. It was great. Maybe Amazon wouldn't have done what they did. Maybe they would have overweighted in something. We don't know. But you take that, you think a company can do well, you hope a company will do well, but it's really a prediction and it's a guess. And so the best way to avoid the risk of misguessing is called diversifying. And so to avoid unnecessary risk or to weigh your risks, you have to diversify. And so the little ice pop umbrella example, it's great to look at an Amazon, it's great to look at a Netflix, it's great to look at some of these companies that have just had stellar returns. But at the end of the day, you have to weigh your risk of being overweighted in the wrong company. There was a time where I remember personally liking Blockbuster's model over Netflix. Who can relate? Right? I don't want to see that tomorrow. I want to see it today. Right? I remember that. So it was like, I'm not going to do Netflix. I'm going to do Blockbuster because we happen to live right by Blockbuster. So I thought that was a better model. Now, I probably could have said, well, if I like it, probably everyone else feels this way. And, I could have invested in Blockbuster because that was my favorite. I didn't know that Netflix was going to completely change their entire business model and just figure something out, get on internet streaming before anyone else did, and become, what was that? I'm just going to throw it out there and I can confirm it, probably 11 times return. Right? 11 times, something like that, if you invested early with Netflix before they divested that whole delivery business, the actual mail delivery. Once they divested that, the stock price has just been insane. And this is something that we noticed, and there are some people whose parents, uncles, grandfathers, whatever, said, hey, go get some Netflix, and they did it, and they saw 10, 11, 12 times return. And right now, trust me, they're enjoying that. Okay? You have to be in it, but you also have to diversify. You have to diversify. With my family, I tell you the question I get all the time is, yo, Rob, if I get 10,000, you can flip that? First of all, I don't guarantee I can flip it. I don't know what a flip is, but if you're talking about like multiplying it by 2, 3, 4 times, and first of all, I do know what a flip is. I'm just saying in this language, I'm like, hey, let's just stop the language for a second. Let's talk about it, And so I'm not trying to flip your $5,000, flip your 10. We used to do that, that was as kids and back in the 80s and 90s. But right now, we're talking about investing. Okay? So if you want to invest $10,000, then you likely need to diversify it and put it away in a diversified strategy because that's pretty much your entire savings. Right? And that's where the conversation unfortunately goes because they didn't take the first or second step, which is saving 10 or 50% of their income. And I'm talking about family members that are principals of schools that have jobs in great firms, and they've been making 6 figures pretty much their whole 30s and 40s. And they asked me to flip 10 grand to play catch up. And it's difficult. And I wish, the best thing for you to do is to be super aggressive about saving. Forget the flipping. You got to have something to flip in order for you to see some of these returns. All right? Let's just go back to the Amazon example. If you put $1 in Amazon, hey, I got a 5-bagger, got $5. Let's go to the store. That's not going to really get, but if you put 100,000 in Amazon, that's 500,000. So it's different. It's about the amount you start with. And that only comes through saving, delayed gratification.
Come on.
You have to save. All right? But, okay, back to this. So weigh your risks. You shared about taxes. You shared about insurance. I think insurance is a very important part of your portfolio, meaning that you can have all these plans and this strategy for the next generation, but part of that strategy should be, what if I die? All right? And that's really what it means. It just means part of my strategy and the goal is I'll make X and X living. This is my income, this is my career trajectory, but at some point that could be somewhat affected by death, dismemberment, illness, long-time illness, things of that nature. So weighing that risk is just buying a small policy, not as your investment vehicle, but instead to make sure that you're not, that you don't have a plan on something that may not happen, which means you working is the only way this plan gets executed. Insurance is saying that even if I don't work, if I do die, I'm put this little money aside, so that way we can still have that same amount and continue on to what? The next generation, next generation, next generation. So our kids don't have to say, why did God do that? And that's such a brilliant, I didn't know that was what most people say. And so that's weighing your risk. Next one here. Avoid unnecessary taxes. I absolutely love this one because this is the most boring one, but the most profitable. This is the most boring one, but the most immediately profitable. Avoid unnecessary taxes. The United States government does not want to pay for every retiree's lifestyle. They do not want to pay for your rent. They do not want Social Security to go bankrupt. They do not want to have to build a lot of public nursing home facilities. So what they say is, we will not tax you on a certain amount every single year because we want you to save. The government gets no benefit from these codes. 401k code. Okay? IRA. They get no benefit from that. There's nothing going to the government. All they're saying is, we really want you to save, and we're putting our money where our mouth is. So instead of you paying us $18,500 in taxes last year, take that $18,500 and you can put it away, and I think I'm saying the right level, I think it's $18,500 now. $18,500, put it away, we will not tax you on it. It'll be tax deferred, meaning we will allow you to put it away until you're past retirement age. We will not pay it. So any tax on it, you can do all your five-baggers and your flipping and all that stuff, and then when you're retired and you're not earning a lot of money, that's when you'll pay a smaller tax on the distributions as it comes out. Think about it. If you're in the 30% tax bracket, that means you've already started out by investing $130 for every 100 you invest. Think about that. You just got $33. If you're in 30% tax bracket, that's $33 for every $100 you invest. And the government is saying, here, it's yours. Just take it. I don't want it. I don't want it. Take it. I really want you to do well. And that's what the IRAs are. That's what 401ks are. That's what 403bs are. These are concessions made by the government that we will not tax you because we want to stimulate you saving. Okay? How many, by show of hands, have a 401k at their job? Great. How many have a SEP IRA? Knows what that is for self-employed? How many know what a spousal IRA is? So spousal IRA, in the same way, is you can just invest money on your spouse's behalf if their spouse isn't working. And they won't tax that either. Down to up to certain levels. Up to certain levels. So it's something to look into. It's called a spousal IRA. And the numbers are lower. It's $4,000 to $5,000 now. $5,500 now. And you can just invest that money tax-free, and it grows. And so these are things you can do right now. Now, here's the thing. You don't have to do that. If you really, really like the government, and you really love the way they're spending, and you say, no, you know what? I want to do my part beyond my part. I don't want to just do my part. We're great Americans, let's do our part. But I want to go above and beyond and make sure they get that extra tax. Feel free. That's fine. Give them that extra 30. That's fine. That's not the way I operate. I say, thank you for that favor. Let me invest it so my kids can have a better future. Okay? $30 in 2018 is going to be a lot more when they finally get it. And so I would love to take that 30 and keep it in-house in a wealth building strategy. So avoid unnecessary taxes. There's no reason to pay taxes when the government is saying, no, please save and we'll give you a tax break. That automatically is putting you in the plus. You're getting P&L right there. P&L, profit and losses, you're getting profit right there. Avoid unnecessary taxes, and that's an easy one. And the last one, easy way, is you have to have a purpose. You absolutely have to have a purpose. And that purpose is, and let me tell you at this point, specifically this new generation, I'm just amazed at the young, the millennials. I know we talk a lot about millennials. The millennials, I'll tell you, they understand purpose. They understand that we are here to change this world. They see something unjust and they jump on it. They're putting their money where their mouth is. They're putting their time where their mouth is. They're putting their energy where their mouth is. This young generation is about that life. And let me tell you something. One of the things that I'm excited about is being able to invest in them. Because that, to me, is a purpose of mine. That is a purpose. I looked at the ability to save. I look at the ability to get equity, the ability to save 10 to 50% of your income for a certain number of years. If you do that consistently, you'll get to a point where you look at a portfolio of money you've saved and you get your 5-baggers or your 2-baggers or some things only return. Let's just forget being smart or being Warren Buffett or anybody. If you just put your money in the general stock market, no one managing it, just general S&P 500, which is the broad basket of stocks, your money would have tripled in since about 2008? No, more than tripled in 2008. Let's say from 2010. And so with this growth that takes place just from doing these real basic things could have put you in a situation, or couldn't have you in a situation where you're like, okay, now I have a nice chunk saved up. Let me take 5% of that and give it to someone in a social impact space. Let me give it to some of these kids in the church that want to go away on these trips. Let me give it to this small business owner, and these small business owners, I just want you to understand this because I don't think people fully grasp what small business owners need. It's called angel investing. It's that first round to get people over that hump that is the most important. Where do they get it from? Friends and family. Okay, uncles, aunts. Gordon Siegel, Crate and Barrel, borrowed $7,000 to get that company started. Gary Erickson, Cliff Bar, had to borrow $20,000 off his father's credit card to start his company. I'm not suggesting that. Joe Gebbia, Airbnb. They actually had to create a little cereal called Obama O's as a gimmick to raise $20,000 to start Airbnb. Lisa Price, she was a stylist on the Cosby Show who was making her own lotions and making her own creams, and it spread through all the stylists, and people were coming in and out of her house. People thought she was a drug dealer. They called the cops on her. And eventually, she realized she had something, and she went and borrowed $5,000 from her aunt to start Carol's Daughter. She started Carol's Daughter, sold it to a private equity firm a couple years ago, and she's independently wealthy, and she can do anything she wants the rest of her life in terms of financially. And so those little investments, those abilities, that's when we talk about legacy, strategy, having a plan beyond just your kids' generation. What about your kids' kids? All right, how are they looking at life, and how are they looking at their purpose? How are they looking at their careers? Right? And that is the purpose. Once you eat away your bad debt, you're starting to save, you start to put equity in the right places, and you're in it to win it. You actually have skin in the game, and you hear all-time high, and you're like, man, that's me. Yes, right? You don't have to follow the market every day, but you start hearing these things. And I do have to comment to this. Let me mention this, because I know a lot of us have fears in the stock market, and the crash in 2008, I believe, still has some people wondering if that's where I need to put my money. Let me read this quote from Warren Buffett. Over the long term, the stock market news, stock market news will be good. In the 20th century, the United States endured 2 world wars and other traumatic, expensive military conflicts, the Great Depression, a dozen or so recessions, financial panics, oil shocks, flu epidemic, the resignation of a disgraced president, yet the Dow rose from 66 to 11,497. The stock market is not going anywhere. It's here to stay. The concept of equity in the U.S. economy is here to stay, okay? On average, if you put your money in the stock market, you're looking to track at about 8% annualized return, all right? And so if you are a little bit ahead of the curve and you buy dips when people start to panic and you follow what Warren Buffett says, you buy from the optimist and sell to the pessimist. I'm sorry, you buy from the pessimist, sell to the optimist. When you start hearing these shocks and he's like, oh my goodness, the Dow's crashing, everything's in a panic, and news of North Korea or this another school shooting or all these things, and the market starts to tumble, you just look at that and say, hey, you know what, people are a little bit nervous, probably time to buy. Because the stock market's not going anywhere. Why is it not going anywhere? Well, because you have this concept called growth of population. And so, in and of itself, if you just let everything go the way it's supposed to go, logically, Apple will have more customers next year because we're having kids. Population's expanding. We're still growing. So inherently, the companies and the entire stock market in general, there is going to be growth because the population will grow and technology will make us more productive. And so between those two things, the concept of the stock market is not going anywhere. And so those naysayers, the people that really got really hurt by 2008, I just really want to encourage you. I know in 2008 I bought a ton, and that the prices just went up because it was at such bottoms. And so don't give fear to the market. I want to open up to questions because I think our time's about up. But if you have any questions with either of us, I want to answer those. But eat away your bad debt, save 10 or 15% of your income, focus on equity, learn equity, enjoy equity, love equity, weigh your risks, avoid unnecessary taxes, and then ask yourself, sit down, husbands and wives, if you're together, families, sit down with your kids, what is your purpose? Thank you.